Standard Time, so I think we'll go ahead and get started with our program today. First of all, good morning and welcome. My name is Bob Canterbury, and I am a certified financial planner and a wealth advisor with BST Wealth Management. Our program today is scheduled to last approximately 30 minutes, with a few extra minutes left over for questions. Our topic today is pre-election financial planning considerations. And I feel this topic is very appropriate for obvious reasons. Many of my clients and other individuals have called and reached out to try to understand the impact of the upcoming election and how changes may be necessary with respect to their own individual investment strategy. There are a few other financial planning topics that we'll add in as well, but we'll go through the slide presentation, and as I mentioned, if we have time, you can type in any questions you have in the Q&A chat session, and our moderator at the end will try to tackle a few, time permitting. Now, before we get started, I did want to mention, kind of a disclaimer here, that the purpose of this program is to provide you with information so that you can make personal informed decisions. This is not designed to sway your voting or any reflection on BST as a firm. It is strictly informational, and hopefully when we finish today, you might have a few takeaways that will help you with your planning and maybe a few steps as far as a plan of action goes. So we will have some conclusion remarks at the end, and I hope it will be worth your while to join me here today. Now, our agenda is to really understand the impact under potential scenarios if Joe Biden is elected as president or if Trump is reelected. What can we expect as potential impact to both the economy and the stock market? So again, this is not designed to be a political commentary in any way. It's really from a personal financial planning standpoint. So once we describe those potential considerations, we'll then kind of move more into the personal financial planning aspect. And in that part of the program, I'm going to spend a little bit of time differentiating between the different types of portfolios that could be impacted here. So for example, some individuals on the call today might be more self-directed individual investors, more stock pickers, if you will. Other individuals might be considered more long-term retirement planning, diversification type of investors. And that's going to be important, as you'll see in a moment when we talk about some of the issues in our program today. And then finally, we'll wrap things up with a conclusion remarks and a plan of action as far as what you need to do and how things may impact you personally. So if that sounds okay with everyone, let's get started and talk a little bit about some of the things to consider the potential impact under a Biden presidency. Well, if you've been watching television, reading the newspaper, listening to the radio, some of these policy items are pretty obvious. And again, just as it relates to the stock market and the economy. Biden has proposed he will come out and probably increase business and corporate tax rates. As you may recall, Trump lowered corporate tax rates back in 2017. And Biden's intention is presumably to increase corporate and business tax rates. On the personal side, you've probably heard many times that his intention is to increase personal income taxes, but only on individuals who have over $400,000 of income. And the proposal there is the current top tax rate under Trump's tax program is 37%. And under Biden's presidency, the plan is to increase that top personal tax rate back up to 39.6%. Again, presumably only for individuals over $400,000 of income. Specific industry sectors that could benefit under a Biden presidency might include renewable energy companies and stocks. So under the part of the Green Deal, the new Green Deal, and climate change, that seems to be one of the top items under a Biden presidency. And conversely, some of the sectors or industries that might be vulnerable under an increased regulatory impact would be financial stocks, energy, and healthcare. Now, healthcare is quite a debatable topic as far as exactly what the policies are going to be. But the reason I point that out, those sectors that I just mentioned, again, is perhaps more relevant to someone who does pick and choose their own individual stocks. So I do have many clients who don't do that. They have hired me to manage their account, and I typically use mutual funds in well-diversified asset classes, and those mutual funds typically hold different stocks from these sectors. And the fund managers basically are in charge of buying and selling based on the viewpoints that we're discussing here today. So I want to differentiate between those who are maybe looking for hot stock tips or reasons to buy and sell versus someone who might be considered a long-term strategy, evidence-based type of investing. Now, to continue under a Biden presidency, there could also potentially be an increase in Treasury yields. As we all know, interest rates have been very, very low for a long time. And the forecast is that not scheduled to increase anytime soon. However, there is a point that if the Democrats sweep both the House and the Senate, there may be the prospect of an even larger debt auctions, which could potentially push Treasury yields higher. So that remains to be seen, but that's a potential impact if the Democrats sweep both the House and the Senate. Infrastructure is another important priority for Biden. It was also a priority for Trump as well, but it kind of fell to the back burner with everything that's been going on with COVID and stimulus packages. And then finally, under a Biden presidency, we might expect to see a lower risk of financial destabilization due to less politicized Federal Reserve. Now, again, these are just pointing out potential impacts to the economy or the stock market under a Biden presidency. And recent polls do show that Biden is ahead a little bit in the voting polls. So depending on what poll you listen to, that's where we stand currently. So what about a Trump re-election? Well, with a Trump win and Republicans holding the Senate and Democrats keeping control of the House, that would leave us with a divided Congress. And typically a divided Congress has historically been better for the stock market. Under Trump's programs, we would expect to see a continued lower corporate tax rate for businesses. Trump also has a priority of trying to reduce reliance on China, and his agenda includes a bid to use taxes to promote reducing the U.S. economy's reliance on China with a Made in America tax credit. So he's trying to encourage companies to remain in the U.S. Another item to be aware of under a Trump administration is energy sectors would tend to do well under Trump, with the exception of renewable energy. His immigration policy has actually reduced the labor pool. So there are stricter policies and enforcement which have reduced the labor pool, and therefore has caused an increase in labor costs for small businesses and companies unless or until he creates additional job opportunities. With respect to jobs, Trump has indicated that his number one challenge is to create 10 million new jobs. And obviously, the COVID pandemic has thrown a curveball into that goal and objective. The PPP loan program has tried to encourage businesses and employers to retain employees if fiscally possible. From a trade perspective, again, kind of going back to China a little bit, Trump is trying to reduce our reliance on China, both from a trade perspective as well as pharmaceutical drugs. We have a strong reliance, as we've come to find out the hard way, on China for drugs and medications. And one of his big goals certainly is to reduce our reliance, both in addition, technology, from a technology standpoint as well. So those are some considerations under both presidencies that you're probably aware of already. And the question is, does this require you to take any action with respect to your personal financial planning situation? Well, I'd like to share some statistics with you that may influence your decision as well. If we go back in history to 1932, and we look at all the presidential election years, the average rate of return in the S&P 500 has been 9.5%. That's in the election year specifically. So this year, as of today, the S&P 500 year to date is up 9.2%. So that's pretty much in line with presidential election averages. There have been some low years, as you see here, presidential election years, the Great Depression, 1932, 1940, 2000, and 2008. But the average has been 9.5%. To show you specifically how has the stock market performed during specific presidential terms, I found this pretty interesting. Believe it or not, the best year was Gerald Ford from 74 to 77. The average annual return there was 20.2. Actually, it's not the, annual market returns. Under Reagan, 15.9, both Republicans. However, under Clinton, 17.6, and Obama, 15.4. So doesn't seem to be, the stock market performance doesn't seem to be specifically related to which party gets elected to the presidency. To further that point, take a look at this chart. And what you'll notice here is the steady increase in the stock market S&P performance, regardless of who's president. We see some small blips along the way, but I think the conclusion here, looking at this chart, is, does it make sense to put all your money in cash and be very conservative for a short period of time, knowing that overall the trend is that the market will continue to do well, regardless of who the president is? It's more based on the economy and the economic situation. Now, what are some other considerations, again, relative to your personal financial planning? Well, there is one indication, kind of leading up to the stock market, or the election rather, that a weak stock market in the 3 months leading up to the election tends to favor the challenger, and a strong stock market tends to favor the incumbent. So what we've seen so far in the last couple of months is kind of a steady, gradual increase. Nothing really that you could gauge either way. There hasn't been a significant drop or really a significant increase. Additionally, 10 of 11 recessions since 1950 have begun under Republican presidents. Excluding 2020, the GDP, gross domestic product, has averaged about 3.6 under Democratic presidents and 2.8 under Republicans since 1950. And then additionally, kind of related to one of the charts we saw earlier, is S&P 500 returns have averaged a strong 10% under Republican presidents, but a stronger 15% under Democratic presidents. So those statistics might surprise you a little bit. From the conversations that I have had and questions that I have received, I think there's an underlying fear that under a Biden presidency, we might see a big dip or drop in the stock market, but you can't assume that that would be continual or permanent. From the charts that I just showed you, it's more about the economy than who gets elected as president. So allow me to point out a few aspects of your personal financial planning that you should probably take a look at. Very commonly, of course, I'm getting questions about 401k plans and retirement assets. If we assume that for most people, that is probably the biggest asset and investment that you have, and that's an investment that you will be relying on income from throughout retirement, generally speaking, it's smart to be well diversified and have an investment strategy that selects an allocation of different asset classes that's consistent with your tolerance for risk. So what do I mean by that? Consistent with your tolerance for risk. Well, let's go back earlier this year when we saw the stock market drop 30% in the first quarter of this year. I had lots of clients who told me previously that that's okay, if the market takes a dip, I'm going to ride it out with the long-term view and assumption that it's going to rebound. Those very same people called and said, take me out, move me to cash, I can't take it anymore. The market's down 30%. Well, for the few people who didn't listen and made changes like that, they missed out on the recovery of the stock market from March of this year to today. And many folks are close or back to even if they did nothing. So again, this leads me back to a comment I made earlier about being a stock picker. Maybe someone who has a separate account, an E-Trade account, where they like to pick and choose stocks based on what's going on today, versus someone who is more of an evidence-based long-term investor. So I would differentiate yourself and maybe separate that from your risk tolerance level. There are various ways to measure your risk tolerance. In general, there's a little quiz that you can take that asks questions about, what would you do if the market dropped 10%? What would you do if it dropped 20%? What kinds of investments are you comfortable with? And basically, it gives you a score assessment. And that score assessment can then be related to whether a 70-30 portfolio or 60-40 or 50-50, which one is appropriate. And that's something that I'll provide my contact information for those of you that want to maybe investigate that a little bit further. I'll show you ways to do that. I also wanted to mention, from a personal financial standpoint, that you can evaluate your tax situation based on the upcoming election and some of the considerations that I mentioned earlier as well. We are assuming that under a Biden presidency, both personal and corporate taxes will increase. So that brings the question, does it make sense to sell certain investments now before the end of the year to benefit from lower taxes versus waiting till some point in the future if Biden gets elected where we have higher tax brackets and tax rates? From an estate planning standpoint, we didn't go into too much detail about that here today, but there is some speculation that estate tax rates may also increase, or the personal exemption amounts on the estate tax side may be reduced, causing higher taxes with respect to estate planning. And from a retirement cash flow standpoint, one of the questions that I get quite often recently, for those who are at or close to retirement, typically those individuals would like to have a safer, more conservative portfolio that will generate income and not be exposed to a lot of stock market volatility. Well, that's good to have that balance, as we mentioned earlier, but creating or generating income today from that portfolio is somewhat of a challenge. And it's mainly because interest rates and yields on bonds and CDs are so very low. You're not getting that yield that we had even as recently as a few years ago. And one school of thought is, well, why not invest in high dividend yield stocks? Well, that could be part of your plan. However, many large companies, because of the pandemic, have elected to reduce their dividend payouts. Not to mention, if I have a basket of high dividend yield stocks, that's great that they may be paying a 5, 6, 7% dividend yield, but what if the stock price itself takes a hit? Now I've lost a lot of money chasing the income, the dividend yield on the very stocks that maybe are a little bit unstable. So it's a tough situation. And for my clients, especially those that are at or close to retirement, we take a longer term view. And from the charts that I showed you earlier, it's less important as to who gets elected as president. It's more important with the standard fundamental economic indicators that we see and that we mentioned earlier. And therefore, from a conclusion standpoint, every individual is different. If you have a personal perception on some of the factors that we mentioned earlier, and you are more of a stock picker, that could influence your decisions clearly. So I'd like to give you some examples for those of you that might be considered a stock picker. Some of the stocks that have done very well this year are pet stocks, believe it or not, pet businesses like veterinarian clinics. A lot of people now are working more from home and feel that they have more of an opportunity to have a pet. And we've seen a big increase in pet ownership. And as a result, pet stocks have increased this year. Renewable energy stocks, home meal delivery companies, and virtual technology. Those might be stocks that certainly have benefited this year. Conversely, stocks that have not done well, hotels, restaurants, cruise lines, airlines. So those are things that if I'm a stock picker, I certainly would consider that, within my portfolio. If you're a long-term investor, most mutual funds will take these types of things into account with their underlying holdings. So just a few conclusion words here. Historically, there has been no clear-cut pattern of either the markets or the economy performing better based on the presidential party. Of course, we're not concerned with history, but what lies ahead. And the Democratic Party indeed has multiple wings, and the left wing of the party is arguably more left than in years past. But Democratic Party voters opted for more centrist candidate. There may be some market risks in a Biden presidency, but no more than an Obama presidency, which had a strong stock market record, as I showed you earlier. There are potential areas of the market that will gravitate toward Biden if he takes the White House, and some of which may be priced in by Election Day. However, there was no real reason to sell stocks simply because of a Trump presidency 4 years ago, and we do not see a particularly strong reason or fear to sell stocks under a Biden presidency either. Most analysis suggests the 2020 presidential race will be close. I think recent statistics do have Biden in the lead. If the economy continues to open up, there is more progress on vaccine. Unprecedented stimulus continues to drive asset prices higher. So as we know, they're currently deadlocked on moving forward with a new stimulus package. If and when that is released, I would expect to see a short-term boost in the stock market. Trump could surprise pollsters again and stay in the White House. However, a weakening economy or stock market between now and election day would likely favor Biden. So importantly, regardless of who's declared the winner, markets historically have had no clear preference for one party over the other. So my hope is, in the time that we've had in this webcast, I've either confirmed some of the things you already knew, and more importantly, how it might relate to your plan of action and whether or not you take action. In some cases, maybe the answer is no. If you're well diversified, the answer is hold the course. It is a good time, in my opinion, to assess your risk tolerance. We could see some bumps in the road with the stock market. And if that makes you uncomfortable, you can't sleep at night, and you have to get up every morning to read the Wall Street Journal, maybe your portfolio is a little too risky for your situation. So that's where I help people evaluate that aspect of it. So in conclusion, I just want to share with you my phone number, our website, bstwealth.com, and my email address is rcanterbury@bstwealth.com. So at this point, what I'd like to do is ask our moderator, Shannon, to see if there are any questions that may have come through. We've got a couple minutes here to maybe take one or two couple of questions.
Yes, so we do have a question in the Q&A. If you have a question, please go down to the bottom of your screen and click Q&A, and I can check your questions there. We do have a question. It is, what do you recommend for 401k investors who are up over 10% year to date? Move to cash to preserve gains and get back in the market after volatility of the election?
That's a good question, and that is a very common question that I've gotten many times. And the answer is, it depends on that individual's age and whether or not they are currently retired. It doesn't make sense to make wholesale changes or move to cash if you have a 10% gain. As I just showed you, we might see a temporary drop in the market, but how do you know how much that drop might be? And if you do move to cash or more conservative position, how do you know when to move back? You have to make two correct decisions. And what we've seen in the stock market is that those big increases in the stock market happen very quickly. And if you miss out on some of those big days in the stock market, your rate of return is going to be about equal to a treasury bill. So for those individuals, I suggest evaluating your allocation. If it's too risky, let's say if it's currently 70% equities and 30% fixed income, it could make sense to go to 60-40, but it doesn't make sense to go to 100% cash, take my profits, because now I have to figure out when's the best time to get back in. And most people are not right once, nonetheless twice. So hopefully that helps.
Okay. And we do have another one. What would be the effect of the stock market if the presidential election is disputed?
Well, that's a very good question. That kind of relates to, the ballot boxes that are being put out. The fact that I hear Trump's not really going to concede the election until maybe a week or two after. I think it also ties into whether or not the Fed stimulus package is going to be passed sooner or later. So I think it's more of a wait and see type of proposition. I certainly would not make any wholesale changes to my portfolio based on the fact that the election results might take another week or two to be finalized. So I don't think that in and of itself would be enough to take action. Maybe one more question?
I do not have one in, but you and I can stay on for another minute if anybody's still typing their question.
Okay. Well, if there aren't any other questions, as Shannon said, I'll hang on the line for a moment, but I'd like to thank you all very much for joining me this morning. I hope you found the topic relevant and useful with your planning. And if you'd like to reach out to me, my contact information is there on the screen. So thank you all very much and have a great day.